Thanks for joining us today on Market Call. I'm Morella Fernandez. Rebecca Teltscher on the show with us today. She's portfolio manager at Newhaven Asset Management. She'll take your questions on Canadian stocks. Here's how to reach us. 1-855-326-6266 if you want to dial in. You could also email your questions, marketcall@bnnbloomberg.ca. Thanks for coming in.
Thanks for having me.
Let's talk about the TSX hitting another intraday high yet again today. It had a couple of record closes last week as well. What's driving momentum right now?
You know, I wish I had just a fraction of optimism that this market has. And I want to say it's almost blind optimism. I think we're back into this good news is good news and bad news is also good news. So, yesterday there was the ADP payrolls report. That was pretty bad. And so what did the market do? It rallied because it was like, hooray, we're going to get a rate cut next week. And then today there was, jobless claims, and that was good. And so the market's like, hooray, the economy is actually doing okay. We're not losing jobs. We're just not adding jobs. And so I think at this point, I've been saying this for over a year, that the market has been disconnected to the economic fundamentals. But I think that keeps widening right now. And I think the market is looking for any opportunity to just grasp onto that optimism and to just, keep it going as long as possible.
That being said, we did have that volatility sort of maybe 3 weeks ago. That was unusual for this time of year. Do you think that was just the lack of excitement or the skepticism around tech and AI?
Again, so there was two things that happened, and it was, again, after the government shutdown, we started seeing some economic data roll out. And I think in that case, what you're talking about 2 weeks ago was the first jobs report that came out that was actually positive, and the market was a little jittery because they were worried that there wouldn't be a rate cut in December. I think right now the market is so dependent on a rate cut, but and that's what's really driving the market right now. It's not so much the fundamentals, it's the expectations of that cut. That cut in next week is priced in. My question is what happens after that? But then just to add to it, we're all talking about the US rate cut next week, but in Canada, we've been consistently cutting rates for the past year, and that hasn't necessarily helped our economy. So, what I would also add is, just because Federal Reserve are cutting rates, that's not, the saving grace that's going to save the economy from a recession. I mean, it's part of it. We are trying to stimulate the economy through cutting rates, but that's not the be-all and end-all, to save the economy.
We've got to look past that. Okay, we're going to take a quick break. We will line up the first phone calls and emails for Rebecca Teltscher, portfolio manager, Newhaven Asset Management, taking your questions on Canadian stocks. Back in a moment. Welcome back to Market Call. Let's start with an email. Will has written in. He says, does Rebecca think this would be a good time to take a position in ARC Resources? It's come back quite a bit. ARC Resources has been dragging for a little while. I don't know if that's the price of natural gas, or I know it had some other issues on its own. We'll pull the chart up in a moment, but would you take a position where we are today? So
yes to both of those. I mean, that's exactly why the stock is off. And yes, I would take a position right now. It's one of those things that you look for, a short-term blip in, let's just say, what's happening. But as long as the overall long-term thesis is still intact, then it's a great long-term buy. So natural gas prices in Canada are low, whether it's, the weather or, there's really at this point not that many places to put natural gas. Like natural gas prices in the US are much higher because there are more LNG export facilities. We're working on it in Canada, and there's a few projects. LNG Canada is ramping up, possibly a phase 2. We have some, Cedar LNG through Pembina. So as we get more export capabilities, natural gas prices should go up. And then the other thing too is they have an Attachie project, which was a little bit delayed, and maybe they're going to be delayed on the Attachie to ramp up. I think there was some flooding issues in the startup of that project, but again, short-term blip, which is causing some, short-term lower guidance. But I think over the long term, this is great. They have high-quality assets, a strong balance sheet, drilling inventory of over 15 years, so they don't necessarily need to be acquiring to keep up production. So I think this is our favorite natural gas holding that we own, and we are going to continue to own it. And we've been adding it more. When it was around $24, we've been buying more.
Okay, that's good to know. Let's get to our first caller. Then we have Michael on the line in Montreal. Hi, Michael.
Good afternoon to you both. Thanks for taking my call. Rebecca, my question's on Northland Power. So I'd like to have your views following their dividend cut and their most recent Investor Day presentations and all. So okay. I'd like your view on that. Thank you.
Thank you for the question. Northland Power has gone down to 17.22, a bit of a steep dive. The high would have been sort of 25.78, which was last month, and done that deep dive since. Where would you sort of buy in here? Would you step in? Is it a stock you're interested in?
Don't remind me, Marilla. This is one that we own, and it's, it was one of my top picks for a long time, and it is so unfortunate. I knew I was going to get a question on Northland Power today. It's the karma's coming back to me, and I, you know what? I deserve to talk. I need to talk about it. And the truth is that I don't have all the answers, and I was blindsided just like the rest of the investment world was, as you could see in the stock price. So,
what exactly happened?
What exactly happened? So they announced earnings a few weeks ago, about a few days before their investment day, and they said their Hai Long project in Taiwan is taking longer than expected with regards to the commissioning. They're going to have to inject some more capital into the company into that project over the next 1 or 2 quarters, and as a result, they are they cut the dividend 40%. Now, and if you listen to the Investor Day, you would have heard my questions on the dividend as well, which, I didn't necessarily get, the most straightforward answer at the time. We have subsequently met with management one-on-one. But, do I think they needed to cut the dividend? I mean, it's hard to say. A lot of these decisions were made by a previous management team. Christine Healy that came in, she's a new management, and it looks like she kind of was thrown into it, whether that dividend was necessary. I personally don't think so. I mean, she stands by that dividend cut. Would I rather see them issue equity when the stock was $25? Absolutely. Would I rather them sell assets, even if it was maybe at a lower than expected price? I would have rather see them do those type of things than cut the dividend, which is really a long-term commitment to shareholders, and it's really breaching that trust to shareholders. So that's where I am right now. I don't, the fact that Hai Long project is delayed, I could move past that. That's okay. We're long-term investors. So, these things happen. The project is very weather particular. So, a lot of these, this project has to be on hold now until the weather gets better in the springtime. These things happen. But what I don't like is to see a long-term, commitment to shareholders be broken in the form of a dividend cut. So where we stand right now, we haven't sold our shares yet. It's trading around $16, $17. I do think the assets that they hold have more value than what it's being traded at right now. The stock is down, it dropped almost 40, 50%. Based on the lack of trust and the lack of transparency that management has shown us. And so my question now is, do we sell it? Do we keep holding on to it? I am not buying more. I'm not averaging down right now. We're still analyzing. We just met with management one-on-one recently. So it's a work in progress. But yes, we're just disappointed along with everyone else. And we feel like we were blindsided along with all the other retail investors as well.
All right, a bit more work to do until you make that decision. Let's go to another caller then. GP on the line in Edmonton with a question. Hi, GP.
Hi, thanks for taking my call, guys. I had a quick question on EQ Bank. I noticed they shot up this morning on news of acquiring PC Financial. What's your outlook on it? Not sure if it's part of your holdings or not, but appreciate your insight on it. I'll hang up and listen. Thanks.
Okay, thank you for the question. They are requiring PC Financial. Loblaw will retain some ownership there as well. So it got a pretty decent bump from this. It's up $9.95 or 11.5% essentially. What did you think of the move, first of all?
Yeah, I mean, the market really likes the move. And, it's not the first transaction, that we've seen in terms of this alternative lending space. I mean, we saw, Laurentian Bank is being sold to, private investors, National Bank taking some of that. So, so we were kind of surprised about the announcement today. But again, it's kind of been the trend with some, M&As going on in the alternative lending space. We don't own it. We don't hate the name, but just in terms of where we think we are in the credit cycle, we don't think we're, in a recovery phase right now. We still think we're in a very cautious phase. And if that's the case, we prefer to be in the larger banks that have a little bit more diversification as opposed to the alternative lenders. It's interesting because their actual earnings that they released were not great. PCL, like the provision for credit losses, were higher than expected. The stock price is kind of ignoring that and really focusing on that transaction, but their underlying earnings weren't great. Last quarter, their earnings weren't great and the stock really came off. So I do think that, it's something to keep a lookout in terms of where we are in the credit cycle. I don't like the alternative lending space. We just feel it a little bit riskier than the traditional big banks right now.
Let's try to squeeze in one more phone call before we take a break. Frank's on the line from Huntsville, Ontario. Hi, Frank.
Oh, hi. Okay, so I own Royal Bank and TD shares, and I have some more money, and I wanted to increase my position in both Royal Bank and TD, and I've been waiting for the last month for it to sell off a little bit so I could buy. So now it hasn't sold off. So now I don't know whether to buy now or wait until it does sell off a little bit. And if you could tell me which one you prefer, Royal Bank or TD, I'll hang up and listen to you.
Okay, thank you for the question. Royal Bank rarely sort of moves down. It tends to move up or have very little volatility. TD is in a different position, of course, than some of its peers lately. But where would you step in, and would you step in at where these banks are today?
Yeah, great question. I like both companies for the longer term. We own both in our portfolio, but I would be hesitant to be adding both right now, just given the move that they've both had. A year ago, I was buying TD. That was a no-brainer.
It was under $100 at that point.
I was like, I was buying it for my clients around $88, $90. That was a no-brainer. But it's had the biggest move this year. Funny enough, RBC, the traditional, like the premium Canadian bank, has actually moved up the least this year. So actually that premium that it has versus the other banks has narrowed. So I think it's trading at a 3% premium versus the large banks on average. And so you could look at that as an opportunity to buy more. I have trouble, buying RBC over $200. Maybe that's the new reality. Again, we like both for the long term, but I mean, I'm hesitant to add new capital at prices today. I just think, again, they both released earnings, both really good earnings. Both of those beats were on capital markets. Both of those beats were focused on wealth management. In a market like we're seeing right now, where almost every asset price is up, it's not surprising. But I would be looking at banks on a traditional banking metrics. Like, let's look at the provisions for credit loss. Let's look at the commercial loans. Look at loan growth. The beats were primarily on the capital market side. So, again, long story short, if I had to add to one, I would probably add to Royal Bank right now because that premium is lower. But I do think there are better places to deploy capital right now. So, like, for example, RBC trading at a dividend yield of less than 3%. I think there are better places to put capital right now with a higher dividend yield that's growing. And you can wait till my top picks to see what those are.
Sounds good. All right, we're going to take a quick break. We'll line up more of your phone calls for Rebecca when we come back. Stay tuned. Welcome back to Market Call. Let's go to the phone lines. Kai's on the line in Toronto with a question. Hi, Kai.
Hi, Rebecca. My question is on Canadian Apartment REIT. Earlier in the year, I initiated about a 5% position, and it's since come off and now sits at about 3% of my portfolio. So I was wondering if I should sell it as a tax loss, counterbalance, or buy more or hold. So any insight you give me on Canadian Apartment REIT would be greatly appreciated. Thank you.
Thank you for the question. We'll pull up the line chart. There we go for Cap REIT. So it's down almost 20% on the year. Any insight here on whether he should hold or just take the loss?
Yeah, so we looked at this about a year ago. We met with the management team. At the time, I wasn't so impressed because, so I like the underlying fundamentals of the business, which is it's rentals, and they're rentals in, areas like Toronto where the tenancy rate is extremely high. Affordability is an issue. So, there's more immigrants coming into the country. They're going to have to rent. They can't necessarily buy right away. So I like the demographics, the long-term trends. When I met with management, I wasn't so impressed with them because they were saying that they were looking to sell off some of their older apartments and buy some of the newer apartment rentals. And then I said to them, I'm like, well, what newer apartments are you able to buy? And they're like, well, you're right, there isn't that many. So they were basically shrinking to grow. So they were going to be selling more units than they're able to purchase. So at that time, I'm thinking, well, what's the value added there? So we didn't buy it at the time. Now it's a little bit more interesting. One, valuation has come off. It's trading at almost a 4% yield. So I think that makes it more attractive on its own in terms of valuations. The other thing, too, is we're actually seeing some distress in some of these real estate plays, like some of the private rental businesses. I can't remember, Centurion or some of these private rental guys are struggling. And so there's an opportunity, I think, now that more so than there was a year ago to be able to purchase some of these newer buildings and either convert them to rentals or purchase rentals outright that are newer. So I think there's more availability in the market now than there was, and you're trading at a more attractive yield. I don't know if I would buy more if you already have a 5% position because that's pretty concentrated, but I probably wouldn't sell it here. That being said, I don't necessarily think it's going to recover in the next few months. But for a long-term ad, I do think it's looking interesting for here. I'm going to start looking at it now more seriously than I was a year ago.
Okay. Let's move on then to Daniel, who is in Markham, Ontario. Hi, Daniel.
Hi, Morella. Hi, Rebecca. Great host and one of the best guests on Market Call.
Thank you.
My question is on TFI International. Do you own TFI International, and do you see opportunity to enter the stock? Okay. Thank you for taking my call.
Thank you for that question. We'll pull up TFI and have a look at that. Is this a stock you've invested in before?
So no, we don't own it. We haven't owned it, and it's not on our radar. But I do think it's important to talk about because look at that drop. I mean, so it is no secret we are in one of the longest freight recessions in history. And so the stock came off with regards to that over the past few years. And then you had that double whammy with tariffs. And so I do think on a valuation perspective, this is probably really attractive right now. For us, it's not something we would look into because it is a little bit too cyclical, a little bit too risky. Where I do think there is an opportunity is possibly in the rails. Like we just met with the CFO of CN Rails a few weeks ago, kind of talking about the same story as TFI in terms of that double whammy of, you had tariffs, you have a freight recession. So things are basically as bad as it's ever been. So, if that's the case, then, it may be a slow recovery, but I do think we are pricing in the bottom from here. Now, the difference between CNR and TFII is that, CNR has more irreplaceable assets. They have those rails already built, east, west, north, south. It's irreplaceable. Whereas trucking, for example, I mean, yes, a lot of the logistics, they already have in place, but the barriers to entry are lower with regards to a trucking business than it is with the rails that are more established, more mature. So we would be more inclined to look at a CN versus a TFI. That being said, the opportunity, I think, is the same. If you have a stronger risk appetite, there could be an opportunity for TFI now. Okay.
So that is a decision he will have to make. Let's go to Janet on the line in Toronto with a question today. Hi, Janet.
Yes, hi. Thank you for taking my call. I wanted to get your take on Dollarama. It's been going up every year. I believe it's about 10% that it goes up every year. Do you see it growing at the same rate? And would you buy it at this current price?
Okay.
Thank you so much.
Good question. Dollarama's been expanding a lot and did some acquisition, I believe, in Australia. A lot of people see it as now even more popular considering how much your toiletries are these days, the things that you need for your everyday. Dollarama, a sustainable model? Do you think it'll continue to grow?
Dollarama will always have a special place in my heart. It's the first stock I ever purchased on my own. This was even before I was, in the investment industry. It was just one of those things that I saw, 15 years ago and I just purchased. Obviously, it's been my best holding. But you know what? We don't own it for our clients. And the reason is because the valuation has been so high, and I didn't think that they were going to be able to continue that growth trajectory as strongly as they did. I was wrong. I wish we did own it for our clients, but it was one of those, it didn't have a high dividend yield, which makes sense for a company like that because it's growing so much. It needs to redeploy its capital back into opening new business, new stores. And they do so really well. Like their payback, for new stores is so short. They have a limited amount of SKUs. So it's a very simple business. It's very easy to understand, and they're just able to copy paste it. Where I had concerns is, when I bought it, 15 years ago, they were opening up 50 to 75 stores a year. I felt like eventually they were going to get to a point of saturation where they weren't able to grow as much. But they've been able to defy that by growing into other jurisdictions, whether it's South America or Australia. The other thing I think that's going for them now is the trade down economics. So you have, like you mentioned, inflation, prices are more expensive. So where a traditional shopper would be, shopping at Loblaws, maybe is now going to be shopping more at Dollarama. There's that trade down effect that I think is very important in a weakening economy that's benefiting them. So long story short, I think it's a great company with a great management team, but the valuation it's trading at is very high right now. It I think was up over 100% last year. It's up, 50-something% this year. So you have to be worried that you could be a great company, but if you're trading at a very high valuation, you do have that risk of multiple compression if, those stock, if the growth in that stock comes down, you're going to see that in the stock price.
Okay, so she's held it for a long time. So should she continue to hold, or would you trim at this point?
I would trim if it got to a point where, you have a single issuer that's too big in the portfolio. Like I wouldn't want Dollarama to be 10% of my portfolio. So I would trim it just to take some risk off the table and to be more diversified. But I do think if you already own it, to keep owning it, I don't think I would be putting more into it at these valuations.
All right. Let's take a quick break. We will be back with Rebecca and her past picks in just a moment. Welcome back. Time now to go through Rebecca's past picks from January 2nd of 2025, so almost a full year ago now. Time flies. Canadian Natural Resources was the pick on the TSX at 45.18 at the time, now to 48.50, a 7% return, 11% total return. It has been a tough time for oil energy stock, with the price of oil being pushed down as much as it has, but it has eked out some investment return for investors. Have you stayed invested in CNQ?
Absolutely. We're going to own CNQ for the rest of our lives, as long as the management remains as disciplined and as strong as it has been, which we have no signs of otherwise. But is it, as your point, isn't it so impressive that they were able to grow and return 11% in an environment where oil prices are down? The interesting thing of all the large cap oil companies, this one has actually underperformed, and I think it's because it's gone through a period of outperformance, and in the past year or two, it's underperformed, like a Suncor or a IMO. But we still, by far, think this is the best-in-class stock, one of the lowest decline rates, the strongest management team, premium assets, and I just think this is one that you can own forever. To me, if it's under $50, I'm buying it. If the yield is over 50%, I'm buying it. They're so disciplined with regards to returning capital back to shareholders, whether it's in the form of buybacks or dividend increases. It's one of our favorite names in the space. So okay. I think right now there's an opportunity. I mean, it's gotten a little bit more expensive and oil prices have come down. But, if we see that price go below $45, I'm going to buy more.
All right. Let's move on to your next past pick, Savaria. At the time, Savaria was at 2026, at the time you recommended it, up to 21.46, 6% return, 9% total return. They do mobility equipment. How did you get onto this one?
Yeah, so it's interesting. It's our way to play the aging demographic. So we had, two choices at the time was, through the senior housing, so the Chartwell, and we did look at Chartwell. It's unfortunate because Chartwell did outperform Savaria because Savaria had tariffs issues. I'll get into that in a second. But we felt that Savaria, so the senior housing is, aging demographics. You're going to everyone's going to eventually have, you need,
go into retirement homes,
right,
and
assisted
yes.
living, absolutely. But then the pandemic hit, and then we saw there were some, issues especially in the long-term care. People didn't want to move into these. There were, there was liability issues. The government had to take control of some of them, I think, for extended care. So our play on this was Savaria, aged at home as long as possible. I know, for example, for my in-laws, they want to stay in their home as long as possible. So eventually, if that means putting in a stair lift, an in-home elevator, wheelchair ramps, they rather do that than move to a retirement residence. So that was our play on the space. And it actually was performing really well. But what ended up happening was, I picked this at $20 in January, and then all of a sudden tariffs came to play. And Savaria as a whole, they have distribution, they have their manufacturing in Canada, in Mexico, in China, and a lot of their sales are to the US. So they became that poster child for tariffs in terms of, selling into the US when their facilities were outside. They've made changes. They now actually have, they are building elevators in one of their US facilities, but also something that's really important for Savaria is all of their items are CUSMA compliant.
So it's been able to benefit from the carve-out.
They have not been able, they don't pay tariffs on any of their items. Actually, a lot of their items are FDA regulated. So they have a lot of patient care products, if you think about mattresses and lifts and things like that, and slings. So FDA regulated were never part of tariffs. And also their items now are CUSMA compliant. So they don't actually have tariff issues. The stock came off because of the scare. So it went from $20 to $16. And since then, the stock has kind of ramped back up to where it should be, and I think it'll continue to grow from here.
All right, let's get to your past pick. NFI Group at the time was $14.43, again January of this year, $13.74. Now 5% downside, a total return 5% drop as well. What's been going on with NFI?
Yeah, it's unfortunate. This one as well. We bought it at 14. It went up to $19. You can see on the chart, and then came back down. So again, they do bus manufacturing. We like, the long-term contracts. We like the fact that these are government municipal contracts that are very stable in nature. Again, a move for buses to move towards, regular carbon emissions to either hybrid or fully electric. So there is that demand. That demand is there. The problem that they've had were supply chain issues. Their seat manufacturer went bankrupt. They have since purchased it. That was the first issue. Then the second issue is there was a battery recall. Again, the liability is not on them, it's on the battery producer, but this does cause delays getting those buses out, on the road. So they are, they have a bunch of buses that are stuck on the manufacturing line that they're not able to get out, and that's just caused the stock to come down. So it's just been one tragedy after the other for them, but the underlying fundamentals are still strong.
Have you stayed invested?
We have stayed invested,
Okay.
yes.
All right, we're going to take a quick break then. Rebecca Teltscher with us, portfolio manager, Newhaven Asset Management. And she's taking your questions on Canadian stocks. We're back in just a moment. Welcome back to Market Call. Rob's on the line. He's in Calgary with a question today. Hi, Rob.
Hi. Thanks for taking my call. I'd like to hear Rebecca's opinion on Algonquin Power. I'd like to know if you see a catalyst for a breakout, and would you buy, sell, or hold this stock, or do you prefer another player in the space? Thanks again, and have a good afternoon.
Thank you for the question. We'll have a look at Algonquin Power right now. What are your thoughts?
Yeah, so I love this space. I love the utility space. And we do own Algonquin. And actually, it's probably been the only utility I've been buying recently because the other ones that we own have just outperformed so much that this is actually, Algonquin is the cheapest way to get distribution assets, particularly in the US. So, we own Fortis and Emera, and those stocks, are now trading at around 18 times earnings, which, is not crazy like, the US market, but it's still just traditionally much higher than historical. So, Algonquin, a lot of our clients own it between $6 and $7. So it's actually done pretty well. Like it's up 30% this year. I do think there is potential to go higher because on a valuation perspective, it's still looking pretty cheap. They've sold off the renewables. They're now moving into a pure play utility that's going to have 4 to 7% rate-based growth, which is pretty good. And they have a new management team in place. Their new CFO is starting in January. I do think that they are set up, to do well. I also think, on a again a maybe basis, there is the potential that this is a takeout. Candidate, right? Because I think there is a need for power, and I think a lot of companies are realizing that they need more distribution utilities to keep up with power demand. And I think, just given the valuation it's trading at, either the stock could go higher or it could get taken out. So we own it for the long term. If it gets taken out at a that'll be, we'll deal with it then. But we do own it right now.
All right, let's go to our next caller. Fred is in Edmonton. Hi, Fred.
Hi, thanks for taking my call. And it's good to talk to you, Barella and Rebecca. I'm interested in Gibson Oil GEI for dividend. I'm a dividend investor, and it looks like it's growing. So I'm interested in what Rebecca has to say.
Okay, Gibson Oil, do you know it well?
I don't own it. There's a partner in our firm that does own it, and he likes it. I think, again, in the midstream space, it is trading cheaper than some of the other ones. It's not that I don't like Gibson. It's just that we prefer Pembina as our midstreamer. And I think it's just more so on the underlying assets. So, Pembina has a mix of oil and gas infrastructure, whereas Gibson is mostly focused on oil infrastructure. So they have oil export out of the U.S. They own, refinery supplies. They sold off their trucking business, but their underlying commodity is more on the oil side. While we do think that's not a bad business, we do see more growth on the gas side with LNG exports and natural gas processing, for power consumption. So we prefer the Pembina that has more exposure and AltaGas that has more exposure to gas infrastructure versus oil. That being said, I think the dividend is safe. It's almost 7%. I don't think you can go wrong with Gibson, but if you can own both, I would own Gibson and a Pembina. Does
Pembina have a relatively similar dividend? I think Gibson is up over 6%.
Yeah, no, so Pembina would be lower in the 5s, but still sizable compared to what you're getting in the overall market.
Okay. All right, I hope that was good for him. Let's go to David in Ottawa with a question. Hi, David.
Good afternoon. Thank you for taking my call. My question is on Bank of Montreal. They came out with earnings today, and they were quite good, I thought, and they lowered their PCL as well. I think it's the only bank that did. My question is, I don't understand why, of all the banks, this is the only bank that has gone down, whereas Royal Bank has gone up $6 today. Is there something that the market knows that I don't, and for the reason that it's gone down by about $3 this morning? Thank you very much and have a great day. Okay,
thank you for the question. A lot of the banks reporting this week, of course, BMO coming out today. Was there anything in that read that made you raise an eyebrow?
Yeah, again, it was the lowest quality beat out of all of those, out of all the banks that reported. And again, exactly what you said. They released, the earnings beat was really because they released earnings, they released provisions back into earnings. So a year ago, so BMO was always trading at a premium, like similar to Royal Bank, and we never understood why. It's actually the only bank of the big five that we don't own, because we felt like it was trading at too much of a premium. It was trading similar to RBC, but it didn't have the same quality or premium of assets that RBC had. It has a lot of exposure to the U.S., more the commercial, like the Midwest and commercial banking. And then last year it came out that there was some issues with the quality of the loans in the U.S. So there was issues last year with performing and impaired PCLs. They took a lot of provisions last year, which I think was the right thing to do, but the stock did come off. It was the right thing to do. It's more prudent. And then today they come out and then they release them back into earnings. So they're signaling that, in the US, everything is okay.
They feel okay about what's going on.
They feel okay that it's a recovery. But I'm looking at it where we are in the credit cycle. I think it's just the beginning. You release earnings back into, you release provisions back into earnings when we're at, the tail end of a recession and we feel like we're going into a growth or recovery phase. I don't think we're here or there yet. I think it's just kind of getting started. So I think it's a little bit premature to be releasing provisions. I think right now banks should be more conservative in taking more provisions. So I'm not buying it, and maybe the market isn't either. But I do think that the issue that we're seeing is that it was a low quality beat. The beat wasn't actually based on fundamental growth in the business. It was based on them putting earnings, provisions back into earnings, which may be premature.
Okay, let's take another quick break. We will have more of your phone calls and your emails for Rebecca when we come back. Stay tuned. Welcome back. Let's go to JJ. He's been holding on the line in Edmonton, and he's got a question today for Rebecca. Hi, JJ.
Oh, hi. Thanks for taking my call. Hi, Rebecca. I would like to have your opinion on BIP listed on the U.S. market, Brookfield Infrastructure Partner. Do you still own it? And if you do you have a price target for it? Thank you very much.
Thank you for the question. So Brookfield, kind of a standard for a lot of people. Do you still own Brookfield?
Yeah, we do. We don't put price targets, on our stocks. We do look at valuation metrics and we do look at prices. But that being said, when you want to own something for 5 or 10 years, trying to figure out what the price is going to be in the next 6 to 12 months is a useless exercise, in our opinion. That being again, it has to do with your time horizon. So we do own Brookfield Infrastructure. We do like it. It has a 5% dividend yield if you own the unit trust. We own BIP.UN. I think if you own BIPC in Canada, it's less. It just because of it trades at a premium. But we still like it. We own Brookfield Infrastructure and Brookfield Renewables. And so, a year ago when Brookfield Renewables wasn't, doing anything, we were buying more of that. And now that took off. And now we're buying more Brookfield Infrastructure because it's only up 10%. But we feel that there's so much growth ahead. The diversification of the assets with regards to what kind of assets they own, whether it's toll roads, infrastructure, utilities, data centers, and the geographic diversification as well. We do think that they have so much room to grow. They're capital recyclers where they buy things at really low valuations and then they'll sell it at a premium, and they've done a really good job of that. So we will continue to own that, and we think it's a good valuation right now.
Okay, let's move on to Jacob in Barrie, Ontario with a question. Hi, Jacob.
Hello, good afternoon to both of you. I just want to ask you, please, about Nova Scotia and how do you stand behind it? Is it to sell or to keep? Thank you very much and have a nice weekend.
We talked about the banks. You own quite a few of them. Scotia in the mix?
Yeah, so we own Scotia. Again, this is what I'm saying about almost all the banks right now. If you own it, keep it. I do think it'll be okay for the long term. Hard to put capital into the banks right now. So Scotia's up, 25% year to date. But it does have the lowest valuation of the bunch and the highest dividend yield, about 4.6%. So I think that's pretty attractive. That being said, I think all banks are trading at a premium relative to history. And we talked about where we are in that credit cycle. Again, they released earnings 2 days ago. I talked about it on BNN, on Tuesday. A lower quality beat in the sense that it was driven on capital markets and wealth management. Where we are in the market, it's not surprising, when markets are doing well, your AUM is going to do well on the, wealth management side. Your capital markets are going to do well because people like issuing equities when their stock prices are up. But the underlying banking, it's not bad, but it's not great. It's not growth. Loan growth is stagnant. PCLs are, for BNS are going up a little bit on the international side. So, again, I don't like buying it here, but I think over the long term, it'll be fine.
Okay. That was Jacob in Barrie. Let's go to Hannah in Toronto. Hi, Hannah.
Hi. I have a question for Rebecca.
Sure.
I want to know more about Constellation Software. It has been falling the whole of 2025. Would now be a good time to buy it or maybe still wait? Thank you.
Okay, thank you for the question. Constellation Software down quite a bit. The leader, the CEO, has stepped aside for health reasons. There are other concerns about the business model. Where are you landing on Constellation?
Yeah, I mean, if you don't mind putting up a longer term chart for Constellation, and you'll see what I'm talking about. So Canada always has this like tech darling that everyone flocks to for a certain amount of years, and then it kind of comes down. Like, look at that chart going from like 2,000 to 5,000 in a matter of 2 years. So it was that tech darling for a long time, and we know those type of things don't last. Valuations that high don't last. It was a serial acquirer. Now, don't get me wrong; it did a really good job. It had a strong management team, and it was doing a really good job of acquiring verticals. The problem is you become too big of a company that the future acquisitions have to be bigger and bigger to be able to grow to the same amount of scales. Once you start getting to bigger acquisitions, there's more competition with the big, tech players. You end up paying a premium price. These growth by acquisition stories don't usually end well. I'm not saying never, but I'm saying for a lot of players, this is exactly what happens, is that it grows, it becomes popular, and then it ends up, the valuation comes back to normal. So I'm not surprised. We don't own it, doesn't pay a dividend. And again, we like to see more organic growth. If you are going to grow through acquisition, that's fine. We want to see organic growth too. We want to see reasonable valuations, which that didn't have. And that's why we're seeing that multiple compression. And we're also seeing now the new tech darling has moved from Constellation Software to Shopify. So, that's what happens in Canada with that small tech space.
All right, we have to leave it there for Rebecca right now. But when we come back, she will share her new top picks. That's coming up next. Join us tomorrow on Market Call. Greg Newman on the show with us, Senior Wealth Advisor Portfolio Manager from Newman Group. Scotia McLeod. He will take your questions on North American equities and dividend stocks as well. Time now for new top picks from Rebecca. We will start with Enbridge, ENB on the TSX, very well-known operator for oil and gas, and has a lot in the pipe for next year. They've got a lot of development projects coming online. Is that why you like Enbridge right now?
Yeah, so honestly, it was really hard to find 3 top picks because I just think that the whole market is trading at such high valuations that it's really hard to find something that I think will outperform. But you know what? With Enbridge, it's like back to the basics. Largest, energy infrastructure company in North America. They just raised their dividend 3% yesterday, actually, and they announced a target where they're going to grow 4% organically, deploy $10 billion next year. I just think they're on track. 2 weeks ago, they announced they're going to be expanding their main line, adding 100,000 new barrels a day. So here's the thing, everyone's asking me since the note last week with Carney, announcing possibly, that memorandum of understanding, a new pipeline. And what do I think Enbridge will do? I'll say Enbridge doesn't need to. I'm not saying they won't, but they don't need to. They have $35 billion in capex over the next few years. A lot of those projects are brownfield projects. So they're on, their existing optimizations, their existing expansions, adding, storage facilities. They don't necessarily have the appetite to take one large, new greenfield project that will have a lot of, political and, regulatory risk. They are able to build $35 billion of capex projects on low regulatory risk. So that's why, we like them right now. I think the pipes are in a better position today than they were, 10 years ago when they were taking on some of those large greenfield projects. They're able to grow based on these small growth projects. They have, a 5-point-something% dividend yield that's still growing based on the growth of their earnings and cash flow. A lot of their earnings are regulated or take or pay contracts. So again, very little commodity price risk as well.
All right, let's get to your next pick, which is K-Bro Linen on the TSX. It is KBL. They do laundry services, essentially, hospitals, hotels, that kind of thing.
Yeah, so this is the smallest name that we own. We're not usually the type to own such a small market cap firm, but this, really checks all our boxes in terms of what we're looking for: stability, long-term contracts, organic growth, and some M&A growth. So the stock is down this year because they did a large well, large for them. It was a transformational acquisition into the UK. It was their second acquisition into the UK. And we feel as if they are really, I think the numbers are understated. They're expecting synergies over the next 24 months. I think they're going to be able to achieve it. They have a strong management team. I just want to say, Rona Ambrose, who I really respect, was added to the board of directors recently. This is a well-managed company. If you think they do the laundry for hospitals, as you said, also for hotels, so very diversified, but also very defensive in the business. So, it's an opportunity when the stock came off when they issued equity to purchase that acquisition to be able to buy more and own it for the long term.
Okay, Kate Brolin there. Let's get to Premium Brands, which is your last top pick for today, PBH on the TSX. What do you like about Premium Brands moving forward?
What's not to like about Premium Brands right now? I will say I was hoping the stock wouldn't, continue will go up. We bought more. If you see that little dip like a few weeks ago, we bought more for our clients at $88. I was hoping it would stay there just until today for our segment so I can have an entry point of $88 for my top pick. But no, it has to go to almost $100. But let's hope it's at $120 next year or even more. There's so much to like about this company right now. They've been for the past few years expanding for their U.S. facilities to be able to take on U.S. projects. So, for example, one of their largest clients is Costco in Canada, and Costco says to them, "That's great. Can you put your products on the shelves in the U.S.?" But the U.S. Costco to go nationwide is a whole other ballgame. So they've been building up their capacity in the U.S. That is now done. So they are now able to take these U.S. orders. They have their first launch. This is an organic sugar-free meat stick that they've launched in the U.S. that wasn't in their earnings last quarter, but it will be in their earnings going forward. It's going to launch in Canada in January. Apparently, these products are flying off the shelves. But if you also look at long-term fundamentals, I'm a mom. I don't have time to cook. I'm a lot of times buying, these pre-marinated, skewers. I am buying, processed meat, deli meats for my kids' lunches. But I'm also searching for higher quality items, organic, less salt, less sugar. These are the products that they do. A lot of their you think of Premium Brands that you don't know their brands, but you do. They're all over Costco. They're in the grocery stores. They do, the breakfast sandwiches for Starbucks. They're everywhere. You just don't see it, but they're able to grow, and I think their expansion in the U.S. will continue to do well.
All right. You got to leave it there, Rebecca. Thanks for coming in. Good to see you.
Nice to see you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.